In this session, I'm going to talk about the liquidity coverage ratio, which is one of the major major areas which has been addressed in Basel 3. One of the major elements of Basel 3 with a very strong intent to promote short-term resilience of the banking sector. Right, that's the major intention behind the arrival of this liquidity coverage ratio. In general, also the intention of BASEL, as we know, it's primarily targeted towards coming up with global regulatory standards, majorly targeting towards capital adequacy. Right, the major focus of any BASEL standard is towards the global adequacy or promoting more and more of liquidity, thus strengthening the banking sector. So even this is primarily looked at making the banking sector more and more resilient, but majorly the target of this particular ratio is from a short-term resilience perspective. Right, so majorly from a short-term resilience perspective, we look at this liquidity coverage ratio. Here, what it simply says is, first the bank has to really understand the complete liquidity needs. When we are talking about the liquidity needs, here it is specifying that look at the liquidity needs for the next 30 days. Under a presumed or predetermined stressed scenario. Understand the liquidity needs for the next 30 days calendar period under a liquidity stress scenario. So which means the bank has to really compute the total net cash outflows. And this particular LCR has defined the total net cash flows as an element as a function of two components. So total expected cash flows in the next 30 days, total expected cash outflows in the next 30 days, and also look at the total expected cash inflows during the next 30 days. And the subtraction of that is going to be the net cash outflow. But these two are looked at in a stressed environment that is initially specified, and in that stressed environment for the next 30 days, whatever are these kind of requirements, the banks have to estimate these two things. And when we are talking about the cash outflows, the bank has to really come out with different categories of liabilities to which it has to pay, different categories of liabilities where the payments need to be made, and if at all any kind of off balance sheet commitments that are there, so that list of all of them is taken, and this is typically multiplied by the rate at which they are to be paid. So this will give the total expected cash outflows. Similarly, on the other side, they can compute the expected cash inflows also. So from an understanding of how much are going to be the receivables, contractual receivables, it could be in the form of loans or loan repayments or whatever the different receivables, I am multiplying with the rate at which they are typically expected to come in. So this is what is the calculation of the total cash outflows. This is what is the calculation of the total cash inflows. And here it's even decided that the maximum cash inflows will be at the max 75% of the cash outflows only. I cannot take the inflows much more than the outflows. So the maximum, there is a maximum cap that is put on the cash inflows, which should be 75% of the cash outflows only. So the difference between the two is the total net cash flows. So what we are simply seeing is total net cash flows at any point of time will be at least 25% of the total cash outflows. Because at the max the inflows cannot be more than 75% of the total cash outflows. So that's the reason you will find that the total net cash outflows will be somewhere around 25% or even more. So that's one dimension. Then what it is saying is once the bank has assessed what are its total net cash outflows over the next 30 days, then it has provided a definition of to meet those much of total net cash outflows, the bank has to maintain high quality liquid assets. To maintain that total net cash outflows, it is expected that the bank has to maintain a high quality liquid assets in such a way that they are more than 100%. So high quality liquid assets divided by total net cash outflows for the next 30 days under that stressed environment, this value should be greater than or equal to 100%, which means this should be greater than this at any point in time. So that is what it has come out with the definition of high quality liquid assets. And all these liquid assets should be unencumbered. They are not set as collaterals for some kind of a purpose. And here when it is saying high quality liquid asset, the intention is even when the market is in stress, even when the market is in a stress, these particular assets should be liquid, should be operating in the liquid market. Means I should be able to convert these assets into cash even when the market is completely on a downturn, completely in a stressed scenario. And at the same time, these particular assets should be eligible for use in any central banking operations. So two major things that it is being specified. These particular assets, whichever the assets that qualify as high quality liquid assets, they should be operating in liquid markets even in a highly stressed financial scenarios, market being highly stressed durations, and even they should be eligible for use for various central banking operations. So these kind of assets get qualified as high quality liquid assets, and in some cases there could be a possibility of haircuts that can be applied to some of the assets and they can be accepted within the scope of high quality liquid assets. But more importantly, on the other side, whenever I am talking about high quality liquid assets, there is a categorization. One, we are talking of level 1 type high quality liquid assets and then level 2 type. When we talk about level 1, they are the highest liquid. Probably I can look at cash, I can look at reserves with central bank, reserves with the RBI or for that matter any central bank. They are high quality, and any other marketable securities that are really backed by sovereign or central banks. So they are like highest quality kind of instruments. They all get classified as level 1. So typically cash, coins, banknotes, and marketable securities which are really backed by sovereign, central bank, public sector enterprises. So all these kind, and the reserves that the banks maintain with the central bank, and even some kind of investments in the domestic sovereign or central bank debt, all these kind of things get qualified as the level 1. So in for these kind of things, there need not be any kind of a haircut applied. Probably 100% can be taken as it is. But when I am moving towards the next, right, there could be slightly less liquid kind, because these assets typically I rate as the highest quality and they are most liquid. So to whatever extent, there is no limit even in terms of how much of these kind of liquid assets can be held by the bank. If possible, they can hold all 100% of these assets to meet the LCR requirement. But when I am talking about level 2 assets, right, when I am talking about the level 2, again there is some kind of a sub classification. There is a classification level 2A as well as level 2B. So here in level 2A we are looking at some kind of government securities, government bonds, T-bills, T-bonds, government securities, or even a few corporate securities, corporate debt kind of securities, or even some covered bonds. They go as the next level in terms of the liquidity, covered bonds or covered securities. So wherever we are talking of whichever qualify as a part of the 20% risk weighting kind of a criteria as per BASEL, even the assets of public sector enterprises, sovereign, central bank, all of them which are going for 20% risk weighted qualification, they all get classified under the level 2A group. Even when we are talking of corporate debt or covered bond having ratings of AA minus and higher, AA minus and higher, they get qualified under the level 2A kind of securities. Whereas when we are talking about level 2B, then much more lower rated bonds. So other corporate bonds or debt which have a rating much below AA minus, or I am looking at residential mortgage backed securities, and some kind of equities under some kind of circumstances, they get qualified under the level 2B. See, generally when it is a level 2A kind of a security, probably only 85% of their value is taken, and at the max this level 2 securities can be only 40% of the total high quality liquid assets. Maximum. So 60% minimum, it should be the level 1 assets only. And when I am talking about the residential mortgage backed securities, probably I am taking only 75% of the value of that. And corporate debt securities, especially at the max between AA plus to an investment grade, all investment grade rated only up to triple B minus to AA plus, I look at 50% of the value being taken, and some kind of equity shares which are qualified. Even in that case, only 50% of it is being taken. But at the same time, what we are saying is whatever the company maintains, the maximum it can maintain in level 2B assets is 15% of the total high quality liquid assets. So you could see that minimum of 60% should come in level 1, right? Level 2 cannot be more than 40% of the total stock of high quality liquid assets. Level 2B cannot be more than 15% of the total high quality liquid assets. And one more important thing that comes out is once it is fully rolled out, now it is going in, it will be going in a phase wise in terms of the real rollout of this typical mechanism, right? See, generally this is expected to be introduced from 1st January 2015, and as per the 2015, the minimum LCR requirement, means high quality liquid assets as a proportion of the total expected net cash outflows. It is expected that in 2015 it is expected that 60% LCR requirement is met. In 2016 probably 70%, 2017 80%, 2018 90%, and by the time you reach 1st Jan 2019, it is expected that the LCR requirement touches this 100% mark. And it can be, the main intention behind it is a quicker introduction or a fast-paced introduction now can cause some kind of disruption to the orderly strengthening of the banking system. So it is expected that a phase-wise gradual improvement in LCR is something that could typically create some kind of a benefit to the sector. And it's also said that whenever this liquidity coverage ratio is being discussed in a regular normal environment, especially when there is no financial stress, and in any case this ratio cannot be lower than 100%. Once it touches the 2019 mark, in no case the ratio cannot be more than less than 100%. So they have to meet it, the banks have to meet it on an ongoing basis. All the unencumbered high quality liquid assets should be maintained more than the total expected net cash outflows. But generally during the period of financial stress, if they want to use their high quality liquid assets, they can very well use them, especially during a financial stressing period. During that periods only, during the period of financial stress only, there is a possibility that the banks can have this particular liquidity ratio fall below 100%. But in all other cases, the they have to maintain the ratio above the 100% itself. So this will typically improve. By doing this, the intention is it will improve the ability of the banking sector to absorb the sudden shocks that are going to arise because of financial and economic stress. The bank would be more and more in a position to absorb the shocks, and because of that we could see that the risk does not start flowing from the financial sector to the real economy sector as it has happened during the recent financial crisis. This will help the banking sector to absorb the shock and prevent the risk from spilling over to the economic sector, resulting in a contagious effect which can threaten the economy to a large extent, right? And so during the period of stress, probably they may not have that 100%, because it's generally appropriate for the banks to use their high quality liquid assets for various other purposes, because liquidity is much lower during that particular period. So that much flexibility is being provided. And overall, it looks like the LCR requirement that came up as a part of the Basel III framework, it looks like a true global minimum standard. It looks like a true global minimum standard for ensuring the liquidity of the banks, right? So this implementation that could start from 2015 onwards is expected to create some kind of waves in the bank, some kind of drastic changes in the banking sector, which could really improve the overall stability of the sector as such. And when I'm looking at outflows, To compute the total net cash flow, there could be a look at the retail deposits for which there is some kind of outflows the bank need to plan out. Then unsecured wholesale funding. Then there is a secured funding that needs to be looked at the different departments, finding out how much is the cash outflow in each one of them. And there are lots and lots of additional things that can be looked at, primarily with respect to the derivative outflows, any other contractual outflows, right? Or any kind of valuation changes on the derivatives. So all these things, excess collaterals held, and because of that the payoffs that are typically required, all these things typically go any kind of SPVs, payment to the SPVs and various other things can very well come out as a part of the cash outflow. Whereas when we are looking at from a cash inflow perspective, as we have already talked of, in case of level 1 assets, there is not much of a haircut, 0%. Level 2A, probably around 15%. Level 2B, in case of RMBS, I am taking a 75%, means a cut of 25% applicable. Or if I am looking at corporate debt and all, I can have a cut of 50%. Any other margin loans, they can be looked at as cash inflows. Margin lendings, especially collateral backed kind of stuff, and even if there are derivative cash inflows, all these things need to be considered as a part of the total cash inflows. And as we have said, total cash inflows cannot be more than 75% of the total cash outflows. So this is how the liquidity coverage ratio can really be used for putting a cap on the short term liquidity damage that can come to the banking sector, and it can improve the short term stability of the sector as a whole. All right. Yeah, if you have any further queries regarding this, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.